everyone, and thank you so much for joining us today for week one of BFSG's four-part fall webinar series, today on tax planning. With that, let me hand it over to Mr. Paul Horn.
Hey, everyone. As you know, today things are more expensive than ever. We can thank inflation for that. I mean, just look at the cost of tickets to concerts or sporting events. My daughter wanted Taylor Swift tickets, for example, and I found out when I looked into it, all I had to do is mortgage my home and sell a kidney. The reality is we would much rather spend our money on literally anything else than taxes. So our goal of this webinar is plain and simple. We want to provide you with some strategies that can help keep money in your pocket. Hopefully help you pay only the taxes that you need to and not pay more than you have to. My name is Paul Horn. I'm the Senior Financial Planner here with BFSG Wealth Management. In my role, I get the joy of talking about everyone's two favorite topics, death and taxes, which is why I'm on the webinar here today. Presenting with me, I'm very lucky to have Kahni. She is a very well-respected CPA, and she's been a great partner for myself and the clients that work with her. Kahni, can you introduce yourself a little bit more?
Yes. Hello, everyone. My name is Kahni Bizub. I'm a CPA and tax partner with Wright Ford Young & Company. We're about a 100-person CPA firm, one-office CPA firm in Irvine, California. And my passion is helping our clients strategize and plan, and of course, get tax returns done. But that's just the outcome of really good planning that we do with our clients. So that's what I'm passionate about.
Thank you so much. Chad, can you kick us off with the first poll?
Yep, absolutely. So for all of you logged in on desktop, computer, or laptop, I'm going to launch a poll. This one is interactive today. Again, we have 3 polls throughout today's presentation. It should have just popped up on your screen right now. The question here, just to start us off and kind of give us a gauge for who the audience is and why we're having this session, is when would you normally start tax planning for 2023? The response is there because there is a replay that we will post of this that doesn't get the interactive poll. Is I should have started by now, around now, January, or right at the tax deadline. I'll tell you, Paul's going to say at the tax deadline is the opposite of tax planning, by the way. Let me leave this thing up for 5 or 10 more seconds while we gather responses, and then I'll close polling and share results. With most people having responded, let me end this thing, and I will share results with the group. It should show up on your screen for just a moment, but the responses here are actually kind of mixed, right? 23% saying I should have started by now, 27% saying right around now, 40% January. I still love that, right? You know, even in January, it's way better than April 15th. And 10% here saying right at the tax deadline. We're not planners at all. Thanks, everyone. Let me give it back to Paul and Kahni.
Yeah, absolutely. Thanks, guys. And I appreciate the honesty, everyone. As Chad kind of took the wind out of my sail here. But yeah, when it comes to tax planning, it really needs to be done before year end. So about now each year is when you should be talking to your financial planner or your tax advisor doing that year end tax planning. Because the reality is any strategies that you want to utilize, most of those end December 31st. So we really need to have time to look at, do the planning, and then try and implement those strategies before year end. So if you're one looking at January or later, at that point, it just kind of is what it is. And there's not a lot of planning that can be done to help lower your taxes. Now, important dates to keep in mind before year end. Right now, we're in the open enrollment period for Medicare. So if you're on Medicare and want to make changes to your plan, now is the time to do so. Or maybe you're retiring at the end of the year. Now is the time, and you're going to be signing up for Medicare. Now is the time to begin to have that conversation as well. Before year end, before December 31st, we need to get the qualified charitable distributions completed, more commonly referred to as QCDs. Roth conversions need to be done for 2023. We need to max out contributions to the health savings accounts or employer-sponsored plans like 403Bs or 401Ks. And then any gifts you want to make to family or friends needs to be done by year end. Now, if you're a procrastinator like myself, realistically, let's call that deadline December 15th. Because realistically, the custodian that you're with, so whether it's Schwab, Fidelity, Vanguard, whoever the money's with, they need time to process these transactions. So try and get the paperwork in by the 15th so they can process the transaction before year end. That December 31st is a deadline for the transaction being processed, not the paperwork being submitted. So here is a brief synopsis of the different strategies that we're going to talk about to try and keep more money in your pocket. And just keep in mind at the end of the webinar, we will provide the opportunity to receive a one-page checklist that can help you as well with some planning. So the first thing we're going to look at is going to be investment portfolios. Talking about the importance of realizing and locking in capital gains and losses, how to avoid the wash sale rules, and the importance of rebalancing portfolios. Now I'm a CFP, so of course we have to talk about retirement planning as well, which will include things like funding your retirement accounts, HSAs, why you might want to consider Roth conversions, looking at retirement account distributions. Are you retired and maybe living off your assets? Are you doing that in the most tax efficient manner? And then again, reviewing elections for Medicare, like we've already talked about.
And I'll jump in on when it comes to the income tax and charitable and estate planning side, is we really want to make sure that you know where you're starting from. To do year-end planning, you have to know where you are and what might be changing between now and the end of the year, knowing what kind of tax bracket you're in, knowing what's coming in terms of extra income, making sure we're looking at your state tax situation, if you have stock options, and then also with charitable planning, what do you want to do before the end of the year? And what does your estate plan look like? Looking at all of this at one time together helps you to see your whole picture and to know what moves you need to make before the end of the year to achieve all of your financial goals.
All right, so let's start with the easy topic, which is investment portfolio strategies. All right, so this year, as of Monday, the S&P has been up 11.5% year to date. Pretty good returns given it's been a pretty volatile year. What's interesting about this year, though, is 7 stocks account for 11% of the 11.5% returns. Let me say this another way. 493 stocks out of the 500 stocks in the S&P 500 account for 0.5% of the total returns. So this is a very interesting year. We have this anomaly where we have just a handful of stocks that have these huge gains. And then the majority of most people's portfolio have little to no gains or potentially losses. So this is an ideal scenario or ideal climate to really try and manage our capital gains taxes. Okay. When we talk about capital gains taxes, let's first talk about what a capital gain is in case you're not aware. Capital gain is simply any gain on an investment that you make. It could be a stock, a bond, Bitcoin, real estate, a business. But let's say you buy a stock for $5 per share and you sell it at $15 per share, right? You made $10 in gains, right? The 15 that you ended with minus the 5 that you started with. Well, of course, the IRS and your state are probably going to want their form of taxes on that. So that's what capital gain taxes are. When it comes to taxes, it's important to understand that we actually pay 2 separate taxes as individuals. The first one is our ordinary income tax rates. We're all familiar with this. This is the taxes that come out of our paychecks. The second tax, which is a little less known, are the long-term capital gains tax rates. And these are tax preferential, meaning that they're taxed at a lower rate. Now, this is important when it comes to investment planning because the time period that you hold the investment dictates which of these 2 tax brackets we'll be using. So if you have a short-term capital gain, maybe you're lucky enough to buy NVIDIA in February and you want to sell it now, lock in those huge returns this year. Well, that's great, but you would be taxed at a higher tax rate because if the investment is held less than 12 months, it's taxed at your ordinary income tax rates. So an individual in the highest bracket, that's 37%. Plus, there's going to be an additional 3.8 net investment income tax known as NIIT. And this NIIT is triggered if you make more than 200,000 single or 250,000 married filing jointly. Okay. But this is a total tax of 40.8%. If you live in the wonderful state of California, you can add at least another 10% in state taxes on top of that. So any short-term capital gains for someone in California in the highest tax brackets, they're literally giving up half of their returns. This is why we want to focus on long-term capital gains. This is a position that's held for at least 12 months. If you buy a position March 1st of this year, you need to hold it until like March 2nd of next year to get those long-term capital gain preferential tax rates. Here, the highest tax rate is 23.8% instead of 40.8%. So almost cuts your taxes in half, which is why we want to take advantage of these long-term capital gains tax rates. When it comes to calculating your capital gains or capital losses, it can be a little bit confusing. So how we do this is we first start by getting the net short-term position and long-term position. This is simply taking your short-term capital gains. Maybe you have 10,000 in gains, 3,000 in losses that are short-term. So we would just net those out. 10 minus 3 equals 7,000 in net short-term gains. We do the same thing then for the long-term position. We take your long-term gains minus the losses, okay? Now let's say you have 10,000 in short-term capital gains and 5,000 in long-term capital gains after we net. Well, if that's the case, all we're going to do is apply the appropriate taxes for each of those buckets. So the short-term capital gains, tax at ordinary income tax rates, long-term capital gains, tax at long-term capital gains tax rates. Now, if we have one that's positive and one that's negative, we have to net the position one more time. So let's say we have 5,000 in short-term losses and 15,000 in long-term capital gains. Well, we would net those two positions, and what that is going to equal is 10,000 in long-term capital gains. In that case, we would then just apply the appropriate tax bracket to that, or in this case, just, that 10,000 would be subject to long-term capital gain tax rates. Now, if they're both losses, and this is happened for a lot of individuals last year, quite possible this happened for you again this year. But if it's both losses, let's say it's 5,000 in short-term losses, 10,000 in long-term losses. Now we have a net of 15,000 in total losses. Well, what the IRS allows you to do is deduct 3,000 against your income immediately. So if you made 100,000 this year, your income is now 97,000 taxable from the IRS perspective. That remaining balance of losses, in this example, that would be 12,000, right? 15,000 minus the 3,000 we used to offset income. That becomes what's called a loss carry forward. So you don't just lose them. That loss carry forward is actually very valuable for future years, because that loss now can be used to offset gains in future years. Maybe next year you make 30,000 capital gains. Now, if you have a 12,000 loss carry forward, you only have 18,000 that are subject to capital gains taxes, for example. Another important thing to consider is rebalancing portfolios. Okay, rebalancing portfolios is just something that should be done. There's different philosophies, whether it's done monthly, quarterly, semi-annual, or annual. It should be done at least once per year. And this is a good example as to why. Let's say you have a portfolio that's 70% stocks, 30% bonds, January of 2008. Well, we know January 2008 was the start of the third worst year in stock market history. So throughout that year, the average loss in the stock market was 35 to 40%. The return on fixed income was around 6%. So what happens is the portfolio at the end of the year, instead of being 30% stocks, it now becomes 30% bonds, and now becomes 42% bonds. So what we want to do is we want to rebalance the portfolio. We want to sell now the overweight that we have here. So that's 12% excess in fixed income. We want to put that back in the stocks. Why do we want to do this? For a couple of reasons. When we look to rebalance portfolios, number one, is a good way to harvest losses. Okay. Secondly, and why I think it's the most important reason, is this encourages us to buy low and sell high. Now, we all know the old adage, right? Buy low, sell high. The reality is the average investor does the exact opposite. They buy high and sell low. So rebalancing your portfolio gives you a disciplined approach to buy low and sell high, right? If we're going back to the example here, we're selling high on the bonds and we're buying low on the stocks. Well, the stocks are down 30 to 40%. They're on sale. That's the time we want to put more money in the stock market. And rebalancing is a very natural way for us to do this. And if you have a 401k, they often have an automatic rebalancing feature. So let's go ahead and talk a little bit more here about some income tax strategies.
So one of the things that's really important as you're looking at your situation and where you're at from an income tax point of view is that things in your life change that also change how you're taxed. And so being aware of that and planning for that is really important. Things like marriage or divorce, a birth of a child, a death in your family, And especially if your employment status changes, if you go from being an employee to being self-employed or the other direction. Those are things that you need to be aware of, how they're going to impact what your situation will look like, and plan for that. And when it comes to knowing your situation, when the standard deduction now is higher than it's ever been. With the TCJ Act passed in 2017, many people who were itemizing ended up benefiting more from the standard deduction. And you can see from this chart where you fall depending on if you're single or married and how old you are. And so it's really important for you to know that, because if you, certain things that you would itemize in your deductions would be like your state income taxes, your property taxes, your mortgage interest, and your charity. Those numbers, how they add up, you want to make sure you know how close you are to the standard deduction. Because if you're below, you might want to do different strategies for, especially with charity planning. You might want to bunch charity into 1 year to get the maximum benefit and change how you're doing it in future years. The other thing that changed was for state income taxes and property taxes, and that affects a lot of people in California, is that we're capped at $10,000. It doesn't matter how much your property tax and state income tax go over that. The only deduction you get is the $10,000. So it's really important for you to know your situation in this mix, because it helps you to plan for those expenses, how and when you want to pay them, or how you may want to bunch them into 1 year to help you get the maximum benefit. So this is an awareness thing more than anything, so that then you can plan from that standpoint.
Yeah, and a real life example for a client we're working with right now. They're married filing jointly, they're under 65, so their standard deduction is 27,700. Their itemized deductions when we add everything up is at 25,000. So we're just shy of in their case, the standard deduction is more than the itemized deductions. That's what they would choose to use. However, they are charitably inclined. They give about 5,000 per year, 6,000 per year to charities. So we're talking about with them is using the exact strategy that Connie talked about. So in their example, they're going to gift 10,000 this year instead of the normal 5,000 or 6,000. Now that's going to put their itemized deductions at 35,000 instead of the 25,000. So now we're going to be able to use the itemized deductions, give them a bigger tax write-off this year. And then next year, since they already did the gifting, they're just planning to use the standard deduction next year.
And I'll just add one more thing, Paul, is that the law that allowed for this higher standard deduction is set to sunset at the end of 2025. And we don't know exactly what will happen between now and then, but using these laws to your advantage before they change again is something that we just want to be top of mind for everyone.
Absolutely.
And so one thing I want to touch base in detail on a little bit here is when I talked about the $10,000 cap for state income taxes and property taxes, the IRS gave us a little bit of a blessing for those who are owners of pass-through entities, in which the IRS will allow the entity to pay the tax, the state income tax for the most part, for the owner, and make it be tax deductible. So in an example where you are over the $10,000 for state income taxes and property taxes, you can literally turn a non-deductible item into a tax deduction with this strategy. And it was new for 2022, so we've been doing it now for 2 years for our clients. We don't know how long we'll get this opportunity, but if you're an owner in a pass-through entity, this is something that we want to make sure is looked at, and that you're getting the maximum benefit you can for this strategy, so that you can turn a non-deductible item into a completely deductible expense for IRS purposes. Oh, and I just wanted to make one other note. I had a note here. If you're in California and you were in the disaster area designation, which most people in California benefited from, the deadlines all changed for us until November 15th. which was a curse and a blessing at the same time. But what what that means, what that means is that if you didn't know about this pass-through entity election, we now have until November 15th to make it for the year 2023. It was normally due back in June. So I'm just throwing that out there because if this is something that might apply to you and you don't know if you've taken action, you still have time. And it's a 1 year thing. We'll probably never see this again where we'll get this extra time, but I wanted to make sure you were all aware of that.
So just to clarify, Connie, if it's a business owner, they filed their 2022 taxes, but they maybe didn't take a look at this election, they could file an amendment and potentially make a change here?
No, I'm talking about for 2023. For
Got it, okay.
2023, they have extra time to make the election. It's normally due back in June.
Got
That
it, okay.
secures that election. So, but now you have an extra time until November 15th to make this election.
Perfect.
And when it comes to closely held business owners are near and dear to my heart. It's what most of my clients are that I work with, and I know them and I know their families. And understanding the planning opportunities they have is really important. Every year is different for a closely held small business owner. And knowing where you are at now and what you can plan for before the end of the year is really important. A lot of clients like to take advantage of purchasing equipment before the end of the year, or even autos if they're over 6,000 pounds gross vehicle weight. And the tax laws that have been in place have allowed very good benefits, immediate write-offs for a lot of things that normally would have to be written off over 5, 7, maybe even longer, more years. And so up till 2022, with this law change, we were able to do 100%. In 2023, it's 80%, but that's still better than writing something off over 5 or 7 years. So if you already know you need equipment or other things that will improve your business, it may be best to do that before the end of the year because of the time value of money you get from writing it off almost immediately. And this needs planning around what I'm suggesting, but we don't know how long these laws will be in place. Right now they're set to sunset at the end of 2025, like I mentioned before, but these are always in flex and could change at any time. So we want to take advantage of them while we have them. And then the same thing about planning for your retirement plan contributions, your charity, whether you want to accelerate income or defer income. There's a lot of planning around that, especially for cash basis taxpayers, which, that just needs extra planning around that. And then also, similar to the California pass-through entity tax, closely held business owners that are pass-through deductions also may qualify for a deduction that's called the qualified business income deduction. It's called the pass-through deduction. And so you want to know if you're eligible for that. Not every type of business is, but for the ones that are, it's an additional deduction that you want to make sure you're benefiting from every way possible. So that's something that we would look at with our clients and look at all these items and see how they affect them, what their individual situations are, and then make sure we're taking advantage of every possible opportunity. I'm not a CPA that likes to cross and be too aggressive, but I absolutely want to take advantage of every law in place that benefits my clients. And so that's something that we're really on the lookout for.
So long story short, if you're a business owner, whether you own a major business or maybe you have a side business you're doing, sounds like definitely should be talking with a CPA to see if you're taking advantage of all these different opportunities. Is that a fair statement, Connie?
Absolutely. And the other thing you want to make sure of is that you know what your requirements are for paying in your income taxes. No one likes to pay them in, but we have to do it. And if you are an employee, you want to make sure your withholdings are correct. And there's 2 ways that the IRS requires that you pay in your federal income tax. A lot of people will qualify based on 100% of their prior year liability. So for 2023, you would look at your 2022 total tax. And as long as that's paid in properly in the year 2023, it doesn't matter what you owe. When you come to file your 2023 tax return, there won't be any penalties or interest. So, but as long as you meet the thresholds of what you're required to do, the rest can be paid when you file your return. If your gross income is higher, then it's 110% of your prior tax liability. And if in California, especially California, a lot of our clients fall into, they can't use the prior year method of safe harbor, but they can use they're required to use the current year method. So that's another reason for us to make sure we're looking at what the liability looks like it's going to be, to make sure that payments, either quarterly estimated tax payments or withholding, are covering the amount needed to be safe from any type of penalties. The last thing you want to do is pay the tax and then pay penalties because you didn't pay the tax when you were supposed to. So this is just an awareness of knowing what you need to do and then making that happen. One comment I want to make is that withholding is considered done evenly throughout the year from the IRS perspective. Doesn't matter when it's paid in. You could do withholding on December 31st and the IRS considered it's done evenly throughout the year. Estimated tax payments, however, have to be made quarterly. And if you miss a quarter, then there could be penalties around that. So most important thing about this slide is that make sure you know what your requirement is. This is easy. Most of these are based off of prior year. And if not, then you know what you need to do based off the current year. So just an awareness is really important for this, for estimated tax payments and withholding.
Yeah, the other place where I really see this is for retirees in the first year of retirement, where you used to have the taxes withheld on your paycheck. Now you're not doing that. So I have seen some people that retirement don't do planning get kind of surprised at year end when they find out how much taxes they owe.
Good point.
Chad, next poll.
Yep, thank you, sir. That was a quick preview, though, but this is a fun one, especially considering we do have a nationwide audience, right? From California to Washington, across to New York, down to Florida and Texas, and everywhere in between, from Phoenix to Vegas. But especially, I feel like even on this slide, you see there's all these caveats for those people that live in California with all these higher tax states, and I assume some of that probably applies to New York too. And so I think what Paul and Kahni asked is, let me launch a poll and say, well, have any of you ever considered, or have you even already done it, relocation, right? From one of these higher tax places to one of these lower tax places. And even if maybe you've done it, maybe you're thinking about it, or maybe you're thinking about it in the future, even if you haven't really considered it so far. So again, I'll leave this up for just a few minutes, just trying to get a gauge, because they are going to get into, well, what does the nation look like from a tax perspective? Where are the hot spots and where are the better spots as you think about tax planning long-term? So with most responses in here, let me close this out and I'll share results. And this is honestly basically an even split. I think we have about 30% saying yes, 36% saying no, and 35% saying maybe in the future. So I think we're kind of all over the board right there for you. Thanks, Paul.
Thank you. All right. So why we bring this up is we don't just pay federal taxes, we pay state income taxes as well. So state taxes matter. What's been interesting is, it's no secret, a lot of people have been leaving high tax states. California and New York, since COVID, have been losing residents faster than they're gaining new ones. A lot of this just has to do with the taxes. Those are the two highest tax rates in the nation. If you're in California, you can afford to live there, that's fantastic. You just pay what I call the sunshine tax to live there. And it's well worth it. It's a great place to live. I've lived there most of my life. I myself did move to Arizona. It wasn't just because of taxes, but certainly this was a consideration as part of my decision when I moved here last year. We will talk more about relocation in 2 weeks. So we're not going to get into too much details on relocation specifically. If that is something you are considering or in the process of doing, I would recommend that you listen to the webinar in 2 weeks. Just plug in that now. But when we look at the marginal tax rates, what we see here is California, New York, above 10%. The interesting with California is there's only one tax that we pay. As I talked about before, we have long-term capital gains tax rate and ordinary income tax rates. California, they're one and the same. So any capital gains that you have is taxed at ordinary income tax rates at the state level.
And I want to make a comment too about when you're considering relocation, I would just say that I have a lot of clients that'll come to me and say, we want to move to Nevada, or we want to be taxed in Nevada, which is no tax. It's a no tax state. But they want to keep their house in California, Newport Beach, and all their cars here, and their business is still here, and their doctor's still here. And I just want to just say, if you want to, especially if you live in California, as a California CPA, I know how aggressive the franchise tax board is. You really need to move if you don't want to be taxed in a high tax state. So just throwing that out there, it's really important. You can't just say you've moved. You actually have to move for California, especially not to come back after and prove that you're still a resident of California. So I'll just throw that out there. And then on the next slide, it's really important, especially because, I've been a CPA for 35 years. I've seen a lot of tax law changes, but I've got to say, since COVID, it's just been nonstop, really fast. Things keep changing, and we just don't know what the future looks like. I'm continuing to be surprised in ways I never thought I'd be surprised with all my years of experience. And so one of the things that's really important is to understand the laws in place now, how they affect you, and the laws that might be coming. Again, that's a guessing game, but you kind of can sense what Congress is doing, what the administrations are talking about, and what changes may be coming down. But managing where you're at is really important. You're going to have higher tax years and lower tax years. You're going to want to make sure that you're managing and planning based on what's happening to you and what could happen in the future, so that you can either spread things out the way you need to or bunch them together to create even more benefit. And so some of the things on here, in a higher tax year, you may want to do more pension plan contributions, retirement planning. You may want to do more charitable gifting. You may want to accelerate certain business expenses that you have. You might do the exact opposite of that in a lower tax year. In a lower tax year, you might actually want to accelerate some income for really good reasons. So these all go together to be based on where you're at and making sure that that's getting looked at.
Yeah, interesting point here. When we're doing tax planning for clients, it's not just for 1 year, it's over multiple years. So as Connie said, there are times where you want to actually lean into a lower year. Maybe you were laid off for half of the year. Maybe you had two spouses working and now one spouse is stay at home, so you're down to single income. Those sort of events might trigger a lower tax year where you may want to start triggering some taxes at a lower tax rate than you would otherwise do. So that's what I call kind of leaning into it. Now, when it comes to filing tax returns, Connie, I have some clients that view their tax return as their first offer to the IRS. I have other clients that want nothing to do with the IRS, and they're very conservative in the deductions they take. With all these different strategies here, do any of them carry a higher risk of being audited, or the rules potentially changing to no longer allow these strategies to be used?
I would say that I mean, no one likes to be audited. It's a terrible thing. But what's important is that you're not leaving things that are black and white off the table. You want to take advantage of the laws that exist, and working with someone who understands the laws and how they apply to your situation is key, so that you're not taking unnecessary risk. And if for some reason you were audited, there's not even a question. It can be supported. It's accurate. Those deductions apply to you. Like I said before, I don't like to be aggressive with my clients, but I definitely don't want to leave any opportunities off the table that apply to them. So knowing that, and knowing, we have tons of experience working with the IRS on audits, knowing what they pick out. If you're going to write off every car you have on your business 100% and say you never drive it for personal, that's a risky position that probably will get looked at by the IRS. So those are the things where an experienced professional comes in and gives you a gauge for how aggressive you're being, how you'd have to support it if it did get looked at. But again, I want my clients to take advantage of every possible strategy there is that's to their benefit.
All right, so looking at plan retirement contribution limits. So how much money can you put into your 401k or 403b before year end? Well, the answer is if you're under 50, it's 22,500. If you're 50 or older, you get what's called the catch-up contribution, which is an additional 7,500. So that's a total of 30,000 that can be put into a 401k or 403b. If you're looking to get lower taxes, maxing out contributions to a traditional traditional 401k or traditional 403b is one of the fastest ways to lower your taxes. If you're able to put in 30 grand, let's say you're taxed at the 25% tax rate, you save yourself 7,500 in taxes right off the bat. Okay. And then we have different other limits here for SEPs or simples or IRAs. These are all the 2023 numbers to the right. You may see 2024 has a question mark, and that's not on accident. Normally this time, if you've been at this webinar in years past, we've had these numbers for you. However, our government has just been kind of slow to move this year. And so we don't have these numbers yet. Now, myself, Mercer, other individuals in the industry are anticipating these numbers to go up because these numbers are typically linked to inflation. And as we know, inflation has been very high the last couple of years. So a safe estimate is probably 3 to 5% increase on these. So for example, on the 401ks, most people are projecting this to go up about $500 to around 23,000. I don't have the final numbers. Don't hold me to this. This is just based on my best guess based on what we're seeing today. All right, now let's look at the IRA and Roth IRA contribution limits. What we're looking at here is how much you can contribute is based on your income and your tax filing status. So if you have one spouse that is an active participant in a 401k or in their employer sponsored plan, like a 401k, that limit is 218 to 228,000. Now, one thing that is interesting to note is if you do have a spouse that is stay at home, so they have the harder job of running the family, taking care of the kids, that sort of thing. Just because they're not working doesn't mean that they can't make IRA contributions. In fact, they still can they are still eligible for contributions to a traditional IRA. So again, good information to have. Hopefully that helps.
So one of the things we want to make sure that everyone knows is if you have a health savings account, which would be part of your medical insurance, it'd be a high plan deductible. This is a very good savings opportunity to contribute to this plan, and it grows tax deferred. And so if you have this opportunity, you should be trying to max this out and taking advantage of this so that you, one, have this tax deferred growth within this plan. Because it's like another medical plan for yourself. And then I wanted Paul to touch base on possibly not even taking that out to pay current medical because you may need that in the future and the benefits of that from an investment strategy.
Absolutely. So Fidelity does an annual study. Right now they're projecting a married couple that reaches age 65 and retires. They're projecting their healthcare costs to be around 385 to 400,000 throughout their retirement. That's a lot of money to set aside. In fact, healthcare is typically the biggest expense for most individuals in retirement. So if you have a HSA, the money can go in their tax after, get the tax deduction. The money grows tax-free, and it can be used to pay for medical costs in retirement. So before it's even used in retirement, that money can be invested in stocks and bonds to help it grow even faster. So it is a great tool to utilize if you have access to it for future retirement expenses with healthcare. Now, maybe you're considering doing a Roth conversion. Let's first talk about what a Roth conversion is, right? When we have money in retirement accounts, it's either tax deferred or it's after tax. Tax deferred is your traditional 401k, for example. The money goes in, you get the tax deduction, it grows tax deferred, it's never seen taxes. With a conversion, what you can do is move that money from that never been taxed account to the Roth, which is after tax, and then that money will now grow tax-free for your rest of your life. So the reason you do this is to get tax-free growth for the rest of your life on that money. But the downside is you're going from pre-tax to after tax or post-tax, so that triggers a taxable event in the year that you do a conversion. So let's say you move 10,000 from a traditional IRA to a Roth IRA. Well, now that's 10,000 in additional taxable income that you've added to your income for the year. So Roth conversions are a great planning tool, but there's some things that you really need to consider if you're thinking about this. Number one, they're best in lower income years. So maybe you retire at 65. That might be a great time once you retire to really consider these strategies. Or maybe you're in a lower income year. Maybe it's, again, you're out of work for 6 months. Or maybe you had 2 income spouses and now one of the spouses is stay at home, so your income's lower. Those would be good opportunities to look at doing the Roth conversion. With the Roth conversion, the advantage is it's going to avoid RMDs, required minimum distribution. So the IRS says on traditional accounts, you're forced to take money out once you reach 73 to 75, depending on when you were born. On the Roth accounts, that is not the case. You're not subject to that. But the other thing to consider with these Roth conversions is the Medicare premiums could be increased because of these. So once you turn 65, you go on Medicare, your Part B and your Part D costs are based upon your last 2 years of taxable income. So the more income you make, the larger the premium cost you have for your Part B and Part D. This is what's called IRMAA, IRMAA. So when we're looking, if you're in that age range, let's say you retired at 65, looking at doing the Roth conversions now, this has to be looked at. Too many advisors and tax planners forget about this. I consider this part of your total cost because if your premiums go up, that's less money out of your pocket. To me, that's the same as paying taxes. It's money you don't have. So that has to be part of the conversation if you're 65 or older, or actually say 63 or older. That's something that you have to count for and have to take a close look at. So some important ages to consider. At age 50, that's when you can begin to make retirement plan contributions. So as we talked about this year, it's 22,500 is the cap for your 401k or 403b. If you're 50 or older, you get that 7,500 additional contribution that you can make. Age 55, if you retire at age 55 from your employer, there's actually, if the money stays at the 401k, you can actually begin to take that money out without triggering penalties. Normally, you can't touch money in a retirement account before age 59 and a half. If you do, you trigger a 10% penalty. At age 55, if you retire from that company and leave the money in their employer-sponsored plan, you can actually get around that 10% withdrawal penalty. Also at age 55, you're able to make additional contributions to the HSA, similar to what happens at age 50 with your 401k or 403b. As we talked about, 59 and a half, that is the age that you begin to take money out of your retirement accounts and you no longer are subject to that 10% withdrawal penalty. 62 is the earliest age for Social Security benefits. 65 is when individuals become eligible for Medicare. And then age 66 or 67, that is what is called full retirement age for Social Security. So these are the first years that you can take Social Security without any penalties to the amount that you receive. And then finally, age 70 and a half is when we can start doing those qualified charitable donations or QCDs. This is where we start doing gifting from your 401k or your retirement plan instead of doing the gifting from like a stock or from a bank account. The advantage of this is it can satisfy that R&D that starts when you're 72, 73, or 75. So it can satisfy that, but also this gives you a deduction. So if your R&D for the year is say 20,000 and you give 8,000 to a local charity, now you just have to take out 12,000, and that 12,000 would be subject to taxes as part of your R&D. But that 8,000 that went to the charity, well, that comes out tax-free to the charity, and the charity gets that money tax-free. So a lot of retirees are not taking the itemized deductions. They are doing a standard deduction. And so if that's the case, doing charitable gifting doesn't give you any tax benefit if you're taking the standard deduction. But if you have the QCD, this does give you a tax benefit when you're retired, but still allows you to take the standard deduction.
Well, can I do one clarification on that RMD line at the very bottom? Specifically
Yes,
because it says not from Roth accounts. So that is specific to IRAs, 401k, 403b, and 457 world out there for all of you employer plan sponsored plans out there. technically in Roth accounts inside the employer's plan, there still are RMDs through the end of this year. But Secure Act 2.0 does change that effective January 1st of 2024. And there will no longer be RMDs from plan-sponsored or employer-sponsored retirement plans. And again, that is regardless of the code, 401k corporate, 403 for universities out there, and 457 governmental. Finally, the IRA and employer-sponsored plans will be aligned effective in January. I just want to caveat there because we do have a question in there that we just answered, but this would say no, but technically it does depend on their age for this year.
Perfect. Thank you. All right. Last thing we're going to talk about is charitable and legacy planning strategies.
So this is really near and dear to my heart. Charitable planning is just a great way to spend time. And if you have charitable intent, you want to make sure you do it in a way that gives, but also gives you a benefit. That's how I look at it. If we want people to be charitable, but we also want them to benefit from being charitable, and that way they can give even more. So the more you have, the more you can give. So one thing is there's different ways to give. You can do straight out cash donations to charities. But one thing I really wanted to mention in detail is if you have shares of stock that you have owned for more than a year, and they've appreciated, you can give those shares directly to a charity and not recognize any gain on the appreciation, but get the full benefit for the value of the deduction. So this is a really great benefit for giving and not having to pay any tax on any of the appreciation that happened on the gift. Now, there's rules around this. You have to have held it for more than a year because it has to be long term. But it's a very good strategy that we help our clients plan for when they're charitably inclined. The other thing would be donor advised funds. We see a lot of clients doing donor advised funds. This allows you to put more in now into the donor advised fund, but then give it over time to the charities you want to gift to. So if you need to bunch your charity into 1 year, but you don't actually want to give it out all to the same charity or different charities, but you want to do it over time, this is a very good way to do that. Private foundations, and then of course, QCDs that we just talked about. Private foundations are fairly complex. That needs a lot of planning before you decide to do a private foundation. But that is certainly some things that families will do to train children and to have a family business for charity. So something like that we see a lot of. And then there's also advanced planning that can be done with charitable trusts like CLTs, CRTs, they're charitable remainder trusts, charitable lead trusts. There are things out there that give you even different ways to donate, give to charity, possibly receive income back. So those are all strategies that if you're charitable inclined, you should understand what each of these are and how it might apply to you so that you could make the best decision of your situation and how much you can benefit while still doing a great thing and giving to needy charities.
Yeah, and donor advised funds, just to circle back to that real quick, those can be great to help manage taxes if you have a high taxable year. So for example, we have a client that had a business, sold his business this year for several million. Obviously income is going to be much higher than it normally is. So we're going to use a donor advised fund for him and his family to get that bigger tax write-off in the year that he needs it most, but he's not going to give all that money. He'll give that money over time using the donor advised fund. Private foundations, I'm just not seeing that much anymore. We can thank the Clintons and the Trumps for bringing those under additional scrutiny. So if you have one of those, they are being watched closer than they ever have been. And honestly, there's just they're complex to set up and to run. A lot of I's have to be dotted, a lot of T's have to be crossed. So just what I'm seeing is more individuals and families going to the donor advised funds over the private foundations these days.
Agree. And I think it's really important too that along with income tax planning, you're also looking at your estate in total and what your what your total assets are worth and making sure you're looking at that fairly regularly. Of course, gifting helps with things that are in your estate, get them out of your estate. And there's many ways that you can gift without any reporting whatsoever. The $17,000 per donor per year allows you to give that away. And you and your spouse can each gift to the same person and have that money out of your estate into the whoever you're gifting it to, whether it's a child or a relative or whoever you're giving it to. And it gets it out of your estate into theirs, and maybe they're even in a lower income tax bracket if they invest it as opposed to you having it invested. So something to consider, especially depending on where you're at with your entire estate. One thing is that you can pay for medical and educational expenses directly, but they have to be paid directly to the institution, and those don't count as gifting and are not subject to any kind of limit. So you don't want to give it to your relative and then have your relative make the payment. You pay it directly, and that avoids any reporting, and there's no limits on that, which is really good. If you do give more, then there is a special tax form that's required. You likely won't owe any taxes unless you've gone through your lifetime exemption, which isn't typical, but it is required to be reported. And with the shift in potential, the lifetime exemption right now is very high for individuals. It hasn't always been that high, and I'm pretty sure it'll come down again, depending on who's in office and how Congress is working, which they're not working very well right now. But depending on how that all shakes out, making sure you know where your estate is and where you're at within the limits that exist for the law is really important, because you may need to do planning around that. And gifting is one of those things that can really help with that.
Absolutely. Just a real life example is we have a client that does both paying the tuition for grandkids and gifting to get the money out of their estate. Estate issues is really not much of an issue unless you have a estate of 5 million or more per person. It's currently over 12 million per person, but it does change to 5 million index for inflation starting 2026 as it stands today. The other thing to consider too is I have another client that likes to gift now and doesn't want to wait and leave a huge inheritance for her kids, because her kids have young kids. So she has grandkids that are, her oldest grandkid is like 6 or 7. And so in her situation, she knows her kids need the money more now than they will in the future. They're still younger. They're still, their income's still growing over time. Their asset basis and wealth is still growing over time. So she wants to give the money to them now when they need it most, not in another 10 or 20 years where their asset base is going to be a lot larger. They're going to have higher incomes, and their needs for their kids will probably be a lot less. So that's another reason she likes to gift now versus waiting for the future. All right, thank you so much, guys. That is all the slides that we have today. So we're going to transition here to questions, and I will let Chad take over for that. But just as a reminder, our next in this series is going to be budgeting and student loans. That is the same time next week, 10 a.m. If you haven't registered for that, just use this link right here to register for that. And if you have any individual questions about your individual situation, feel free to reach out to Kahni or I. Or else, if you'd like a year-end planning checklist that I mentioned at the top of this webinar, you can reach out to me and we're happy to provide that to you as well, no cost. Chad, go and take it away.
Thank you, both Paul and Connie. Great presentation. So we do have a ton of questions here in the queue. Again, before I get to those, just as a reminder for all of you or new, if it's your first time on a BFSG webinar, in the Q&A box, there is a thumbs up icon next to each question. So rather than type a question that might have already been asked, if you do see one that you just really want to hear in an effort to make sure that we address call it the most requested questions first, click that little thumbs up, and I will be asking questions in the order of the most upvotes before getting to based on the order they were received. I did just see a hand get raised in the participant box. As a reminder, for compliance purposes, we are not unmuting lines on today's webinar. Please do type your questions into the Q&A box. I will lower those 2 hands in just a few moments. So the first question I have here, with a lot of upvotes, by the way, group, is, so if you were to move to a lower tax state, how many months or how many days in the new state is needed to be considered a resident?
Typically 12 months is what they require. Now, each state's a little bit different. Connie, if you want to chime in there.
Yeah,
Um,
yeah. Oh, go ahead. Go ahead, Paul.
okay, I was gonna say just the other thing too is a lot of times people will try and like snowbird it or sunbird it, spend some time in one state, but they still want to come back to their original home state to see grandkids, see family, see friends. The general rule that I give is 2 to 1. So for every 1 day or 1 month that you spend in where you left, you need to spend twice that amount in your home state. So theoretically, you should be spending 8 months in wherever you relocated to, and then 4 months elsewhere, wherever you want. Connie, what do you want to add to that?
Oh, I was just going to say that you really need to be careful in this area because for example, California will actually look at your credit card receipts and they will look at everything to determine where you actually are and where your nexus really is personally of where you spend your time, where your kids are, where your real estate is. So I just think this is an area you need to do very carefully. When you move, you're a resident of that state when you move. But if you keep going back to where you moved from, that's where then that state can say, no, you really didn't move. So that's just something that there's no cut and dry number of months necessarily, unless you're, it's just a complicated area that I want everyone to understand. You have to be really careful and do your planning and research, especially if you're moving from California to another state. That's where the most of the issues are.
Yeah, there's some attorneys that I work with that specialize, have made a living in just helping people leave the state of California because they are notorious for helping or for tracking people down.
That's
I
right.
myself have left California 3 times, and I've been audited 2 out of 3 times that I've left.
The next question we have here, group, and I got a few of them, is do we share recordings of this call or the PDF? So actually in the chat box already, I've pasted a ton of links. The first one is a link to that survey. The second one is actually a link where that you'd be able to download the slide deck that Paul and Connie used today, in case you would like to reference it at a later point in time. This recording has been, or this webinar has been recorded. We will have a recording up on our YouTube channel. That's BFSG University. Hopefully by tomorrow morning, if not late tomorrow afternoon. It usually does take about 24 hours for us to process it and distill it down and get it onto our YouTube channel. But so yes, there will be replays out. There will be 2 emails from BFSG tomorrow, one from our Zoom account that's automated that includes a little of this, and then a second one from our team. It will be the only 2 emails we send out. We do not spam anybody that attends these webinars. But the second one that comes directly from our team instead of Zoom will actually have a number of links and resources. Again, Connie's information in case you would like to reach out to her directly as well. So the next question I have here, and this gets to your filing status, group, is can you select both married and head of household?
No, you are married or not married when it comes to the IRS rules. And so head of household is if you're unmarried and have a qualifying dependent. So married filing jointly or married filing separately is your only option when you're a married individual.
Thank you, Connie. Next question I have here for the 2 of you is, what do we mean by maxing out your HSA?
That's an excellent question. So an HSA has a contribution limit, just like any other retirement account. For the 2023, that limit on the HSA is $7,750 for a family. So that is the max that you can add to the account this year.
So, and the next question, it goes right along the lines with HSAs here too, is if my spouse is contributing in their work and their plan at work, can I contribute in my HSA plan at my firm? I was told no, as it would be double dipping. Only one spouse can contribute and utilize the plan. So I needed to default to an FSA.
Oh, so the answer is, like, okay, so the max that you can do as a married couple is $7,750 for 2023. The IRS treats a family as a unit, so that's the max total. Now, if you split that in half and each spouse did half, technically that works fine. Much easier for accounting and to avoid any potential problems is to just have one of the spouse max it out. so that you're not quote unquote double dipping. What you can't do is each spouse put in 7,750. That you cannot do.
So the next one I have here is, can we use direct deposit from a paycheck to contribute to a Roth IRA?
Unfortunately, no. The paycheck goes direct deposit into your bank account. What you can do is you can't pay it from your paycheck, but for a Roth IRA on the same day, let's say you get paid on the 1st and the 15th. Well, on the 1st and the 15th, you can set up a transfer from your bank account to the Roth IRA and funnel it that way. But you can't have your Roth IRA contributions come directly from the paycheck.
Next question here. This gets to Medicare Part B, D premiums based on last 2 years of taxable income, quote unquote. Does this mean the last 2 years from when you apply for or start Medicare, or is it a moving target as you are on Medicare?
Oh, the IRS is so nice. It's a moving target. So each year that you get older, they're looking at the previous 2 years. So if you're 65, they're looking at 64, 63. If you're 67, looking at 66, 65.
Next question here is, can you explain IRMA a little bit more, please?
I can. IRMA is the additional contribution. I think I might have a slide here on this. Let me see. I do not, unfortunately. Okay. Bummer. Okay, so I thought I had a slide there. Anyways, with the IRMA, what happens is you have to make premium payments for Part B and Part B, Part B and Part D. Part A, you've actually paid into. So there's no premium payments for Part A, okay? Part B, the cost starts, I believe, at $140 per person per month. And then depending on your taxable income from the last 2 years, it can go up. If you're not careful, instead of paying like $140 a month per person, you can end up paying like $500 or $600 per month per person. So that's why we need to do additional planning. And the magic number when we're doing this number is we really need to avoid around, I would call it 220,000. If your income is more than that in retirement, what happens as a married couple is now you're get a huge bump in your IRMA cost per person. So you have additional monthly premiums that you're paying. It's going to go up about $200 to $300 per month per person. And then on top of that, you get very close to triggering what's called NIIT, the net investment income tax, which is that additional 3.8 tax you pay on your investments. So there's a number of different tax things that we have to look at when we're doing these Roth conversions, which is why I would strongly recommend that you work with a professional.
Sir, the next question I have here gets back to making lump sum tax payments. Is it true that you can pay estimated taxes all at one time during the year? Kind of assuming that you get the dollar amount right, and you don't have to do it quarterly?
So I'll jump in on this one. So that assumes when you make the total payment. If you did it in April for the year, so April 15th is when the first quarterly estimated tax payment is due. If you paid it all then, you'd be fine because you would have paid in early. But if you waited till September or October to make the total payment, you would be late on the first 2 quarters. So estimated tax payments are based on the day you pay them. Withholding is where it's deemed even throughout the year. So I hope that answers that question.
I think it does. Next question, let's get to this fun one, to relocation. I've heard there's a 22% exit tax for leaving California. Is that true? And what's the tax based on?
It is not yet true. So this is something that's been kicked around in Sacramento. It's been proposed, and this would be a tax. And don't quote me. It's like 20 or 30 million. If you have a net worth or a business more than that, then the income from that would still be taxable to California if you were a full-time resident leaving. This has not gone into effect, and this will not impact the vast majority of people that do leave, if it does go through, at least in its current form.
The next question gets to RMDs. What determines the age at which you must take RMDs? I think this is because we had 72, 73, and 75 on the screen, and right, this is now a decade-long floating target.
The IRS is the short answer. Tongue-in-cheek answer, of course. Realistically, what happened is it used to be 70 and a half. which is the same age. If you remember, the number for the QCDs was 70 and a half. That used to be because that was the age that RMDs were triggered. We had the Secure Act come through, and part of the Secure Act, it raised it to 72. Recently, we had new legislation with Secure Act 2.0, and that raised it from 72 to now 73 to 75 based on the year that you were born. It's very similar to what we saw with Social Security being raised, where it used to be 65, and then it became 66 or 67 based on the year that you were born. Same type of methodology was adopted on your RMD contributions. That's why it's kind of confusing. Realistically, if you're retired or very close to retirement, you're probably 72 or 73. If you're, in your 50s or younger, you're going to be somewhere between 74 or 75.
Let me add context. So Secure Act 1 from a few years ago increased it to 72. Secure Act 2.0 of just this year actually increased it to really late last year, increased it to 73 for anybody retiring in 2023. So if you retired in 2022, it was 72. If you retire in 2023, it's 73. And the 75 is not actually in effect yet, but there's an automatic provision in Secure Act 2.0 that in 2033, it's going to move this up to age 75 automatically. So no one's really going to be qualifying for that age 75 for another decade or so. But for anybody retiring right now or is turning age 73 this year, that's the rule that you're following. The next question I have for you to here is, how is domestic partnership considered in the eyes of the IRS? Do they follow married or single limitations?
Well, that's a really good question. I have to say, I don't know that answer. But what I will be willing to do is if you can reach out to me, I will research this for you and get you a better answer, since I don't know how to answer that without.
My understanding is this a domestic partnership, is it still treated as a single status? Unless there's like a kid from a prior divorce, then then it could be head of household and single, or head of household and head of household. But my understanding is it's not eligible for married. Now, I'm not a CPA, so I could be wrong, but I'm like 95% sure that's the case.
The next question is, Connie mentioned not using HSA money now and save it for later. Does that mean one can use non-HSA money to pay for bills, then declare medical expenses for deductions when filing ITR?
You can do that, but I will say most people don't reach the threshold limitation for actually being able to deduct medical expenses as an itemized deduction on their tax return. So you'd want to look at that carefully. The strategy is, if you don't need that HSA money now and you can pay those bills, that HSA money grows tax deferred and therefore is way more benefit to you in the future possibly than it might be now.
So the next question I have here is, are there annual limits to QCDs?
There is. The current limit is 100,000 per person per year. So a married couple can do up to 200,000 in QCDs per year.
So next question I have here, and I might take this one, but do I have to leave the entire 401k in the company to avoid the penalty of 10%?
I'll let you take it, Chad.
Yeah, the question is well, are you still employed? If you're still employed and you're under age 59 and a half, you are not going to be able to take the money out, period. If you terminate employment with that employer, if you're under the age 59 and a half, the only way to avoid it is to either leave it there or move the money into an IRA, right? Some other qualified tax deferred, or if it's Roth IRA. If you're over age 59 and a half, you avoid the 10% penalty either way. And so it would no longer apply. But yeah, there's no requirement to leave. Like if you terminate employment with one of your employers, there's no requirement to leave the money there to avoid that 10% tax, as long as you move it into another retirement type of vehicle, like a traditional or Roth IRA. Next question I have here is, how do ESOPs or employee stock ownership plans play into all of this?
That's actually a separate conversation, so I would like to take that one offline. What I would say is this: ESOPs, when you make the contributions, are not taxable. Typically, upon distributions, at that time is when you trigger the taxable event, but it depends on the business structure and a few other rules. that make it a little bit more complex. So I can't just give you a broad answer here. I have to know more specifics.
This is a little bit individualized. So next question I get here is, what happens if you're planning on living half-time California, half-time in another state? Is it wise to specify each time you are moving?
Well, there's many other facts and circumstances that would need to be looked at in this situation to determine where your sources of income are, what other activity you have in terms of where you're a resident versus where you're a non-resident. So this would take extra research and understanding of the facts to be able to answer that question. But you're usually a resident of one state and a non-resident of another, and it depends where your sources of income are that will drive where you're paying the state income tax.
We cover this more in depth. Like we will be talking about relocation in 2 weeks and all the tips and tricks around doing it. So I would recommend listen to that webinar live or listen to the replay. But again, you don't want to do half and half. You're making yourself subject to additional scrutiny, especially if half the time is California or New York. Again, the general rule is 2-to-1, like I mentioned earlier. The other part of this is they're going to be looking at things like, where's your dentist at? Where's your attorney at? Where's your bank accounts at? So using like a local credit union, if you move out of California, and let's say you go to Idaho half the time, we'll have all that stuff in Idaho, have your larger home in Idaho. So another thing that they look at is just values of property. So I had a client move to Phoenix, had 2 properties, had a condo in Orange County, had a home in Scottsdale. The home in Scottsdale was less in value, had a lower value than the condo in Orange County. So the California Franchise Tax Board tried claiming that they were a California resident, higher value.
Yep. So as a reminder, I know Paul's mentioned that next webinar talking about relocation. So upcoming next week is budgeting, debt management, and student loans. So back to the basics, really. But then the third one we're doing in this series is actually just embracing unconventional golden years here, right? Is like a lot of people retire and they don't just stay home. Like what are people doing to make retirement a little bit different from getting RVs or traveling the world and it's doing things a little bit differently than just retiring and sitting on your couch binging Netflix or playing golf every day in your local backyard. So I think again, that's what Paul's talking about is people are relocating part-time, full-time, whatever it might be. And what are some things to be thinking about that we just see a lot of clients doing that seem a lot of fun. The next one here, and this one came in relatively early in today, but didn't get any thumbs up, is this goes back to, I think, page 13, the business owner page. What was the second deduction called? Like pass-through?
Yeah, that's the pass-through deduction, is the qualified business income deduction. If you're an owner of an S corporation or a partner in a partnership, it may apply to where you get an additional pass-through deduction. It's a 20% deduction on the income from that entity. There's other limitations that determine how much deduction you get. But if you are an owner in a pass-through, this is something you'd want to make sure you knew if you were able to take advantage of or not.
The next question I have is, how long do you need to be in a new state before you retire so your original state does not get the tax money on your retirement?
Typically 12 months. A more common, like just to kind of help illustrate this, let's say that you spent the first 7 months of the year and let's say you're working, you have a W-2 that you're getting each year, and you lived in California for 7 months and then you moved to Nevada for the last 5 months. Theoretically, the 7 months you're in California, that part of the income goes to California. And then the 5 months that you're in Nevada, that goes to them. The whole challenge is California is very aggressive in going after individuals after they leave. And the burden of proof is on you, not on them. And so if you're retired, it's a little bit more murky, which is why we're giving you all these best practices and rules, general rules to kind of follow to give you the best chance of not having to deal with that.
I hope that helps. Next one I have for the two of you is it better to contribute a large sum into your IRA account to help at the end of the year for tax planning? And would it help you pay less taxes?
Always good to make retirement contributions. There's a couple parts to this if we're going to answer this. Is, are you eligible to make the contributions? Because we have to look at these income limitations. to get the deductibility for the contributions. And then secondly, just to specify, if we're talking about a 401k or 403b, you have until year end to do this. So if it's an employer sponsored plan. If it's a traditional IRA or a Roth IRA, an individual retirement account, that deadline is actually April 15th or 16th. So you actually can make the contributions in January, February. This is one of the few planning strategies that you do have access to after January 1st to potentially lower your taxable income.
Next one is if you did not participate in an HSA so far in 2023, can you still enroll and max it out before year end this year?
Potentially. So unfortunately, the caveat to qualify for an HSA is you have to have what's called a high deductible healthcare plan. Number one, not all employers offer high deductible healthcare plans, so you may not be eligible just because of that. Secondly, to make a change, it has to be during your employer's open enrollment. For a lot of people, that is around this time of the year. And so you could make that change and max out contributions before year end. But if let's say your open enrollment for your employer is in September, that window's passed. You can't change to a high deductible healthcare plan. You can't make it if you don't have the high deductible healthcare plan to begin with.
The next question comes, and I think this is anonymous, but I think it went back to HSAs and maxing it out. And one of the questions, and what happens if if your expenses, like medical expenses exceed what you could contribute to your HSA?
Well, one, this is why we want to delay touching the HSA so that it grows to help cover those expenses in time. And secondly, let's say you have 20,000 HSA and you have 30,000 medical expenses. You're on the hook for the other 10,000 from other sources, whether it be from income, from savings, from other investments, whatever the case is.
The next question is still on HSAs: is what's beyond the maximum limit you can save? Is there a catch-up contribution that similar to like 401ks and IRAs, and how much is that?
It's $1,000, and the age for that is 55.
No, that's a different age than it is for IRAs and 401ks that are at age 50. This is a little bit later catch-up start date.
Yes.
Okay, next question here is how much penalty do we pay when retiring at age 62?
I assume this is Social Security.
Yeah, I mean, let me start with like just basics plan, like IRAs and 401k, 403b, 457. There's no penalty if you take distributions after age 59 and a half. So let me give Paul, what if it was Social Security instead?
If it's Social Security, and let me make this very clear, there's a difference between when you retire and when you start Social Security benefits. You can retire at 62, live off your own assets or rental income or have another job, whatever the case is, and not start your Social Security until 65, 67, whatever the case is. If you retire at 62 and start your Social Security at 62, which is the earliest age that you're eligible, what happens is there's an 8% reduction in your benefits per year. Before that was called FRA, or full retirement age, which is 66 or 67. So let's say your full retirement age is 67 and you start collecting Social Security at 62. That's a 5 years that you're taking it before your full retirement age. At 5 years times 8%, you're going to have roughly a 40% discount on your Social Security benefits for the rest of your life.
Thank you, sir. Next one, if I sell my investment property, can I do a personal donation to my sister?
Need more details on this. Are you trying to give this property to your sister, or are you trying to give the proceeds from the sale to your sister? If you're trying to give proceeds from the sale of the investment to your sister, it's $17,000 per person without triggering charitable, having to file tax form 709, which is charitable gift tax. Yeah, so that one, if that didn't answer your question, reach out to us and we're happy to answer that.
So next one, my guess is it's going to be it depends, but married filing joint or married filing separate? Which is the better filing?
Well, part of this depends on where you live. As a California CPA, and most of my clients are California residents, when California is a community property state, so basically married filing separately usually results in a penalty to our clients and not a benefit. So married filing jointly is typically the better result. And we have ways that we can run that to determine that, but it does depend on if you're in a community property state to determine that.
Next one I have is, so what does head of household mean in the table we've been showing?
So this is a filing status when you are not married and you have a qualifying dependent like a child. You're able to qualify as head of household and get a little bit more preferential treatment than if you're just single without a qualifying dependent.
Thank you. And then the next one gets back to, can we talk a little bit about the $5,000 credit for a business to start a retirement plan?
Okay, so part of Secure Act 2.0, if you have a business and you're starting a retirement plan for the first time, they will give you a credit of $5,000 to help with the taxes for starting that plan. I do believe we have a blog post on that we can put in that link there.
It is in the chat box.
Perfect.
Okay, so the next one is for HSA, for domestic partnership who share insurance plan, can each partner have their own HSA account and each contribute the max HSA?
Honestly, reach out and let me double check. I believe the answer is technically yes, but I need to research that to confirm. That's a great question. I've not been asked before.
So next one that I have here is, are HSAs only through your employer? Can you go to your bank and open HSA, allocate paycheck to a bank open HSA?
So HSAs can be opened. Well, number one, you have to have the qualifier like we talked about of the high deductible healthcare plan. Secondly, it has to follow the rules that your employer sets. Your employer may say you can only use Schwab or Fidelity or Vanguard or whatever the case is. If your employer allows you to go outside, then yeah, you might be able to go to a bank and open an HSA or something like that. So you would have to talk with your HR department to really answer that question.
The next one here is, what is the statute of limitations on SALT?
Is it statute of limitations or I'm not sure I understand the question, but the
I guess
maximum.
it's, what is the status of
Yeah,
limitations on SALT? Yeah.
yeah. The maximum is currently $10,000, and that would include property tax and state income tax in that cap of $10,000. That is set to sunset at the end of 2025. So that's another reason, though, why you'd want to know if the pass-through state income tax deduction was allowed in terms of getting that benefit because of that limitation. But it is $10,000 currently per year.
The next one I have, and this is just a fun one. I don't know if you actually know the answer, Connie, but this is for somebody in Florida. What's a reasonable rate to pay for a CPA in Florida?
I have no idea. Sorry.
Yeah, I think that obviously that's going to vary, right? You can do anything from H&R Block and TurboTax to that might be cheap to some of these like real big CPA firms that might be more expensive. Like your situation, your complexity, just like it is here, right? I think even CPAs within Connie's own office, the complexity of your situation is going to dictate the overall cost of doing tax planning and taxes for you.
Absolutely.
The next question I have here is for a traditional IRA where I can't take advantage of the tax deduction. Is there any tax advantage available during contributions or withdrawals?
All right. So if you cannot take the tax deduction, if your income is above those thresholds, what happens is the money goes in after tax. So you don't get the tax deduction. And then that money grows tax deferred and is subject to RMDs. Now, there is a thing that you can do where we can do what's called a backdoor Roth contribution, where we do a conversion, like we talked about those Roth conversions, and you move that money from your, sorry about that, from the traditional IRA into a Roth IRA. If you are going to do it that way, though, there are some additional rules that we have to follow because you're subject to what's called the aggregate rule. And if we trigger the aggregate rule, it may trigger additional taxes. The best way to do this is inside of your employer sponsored plan. especially if they offer what's called a mega backdoor Roth conversion. If they don't offer that, they should be talking to us and we should be getting them set up to be able to do that, because that is a fantastic benefit to have access to.
Excellent. Last two at this point. So you say pass through for businesses. Does this include an LLC?
Possibly. So the pass-through deduction has other limitations, but you need to be an LLC, a partnership, or an S corporation, and then meet the other tests. So I can certainly go into that with more detail with you if you'd like to reach out.
And the last one we have here, unless another one comes in at the last minute, is can a single person claim head of household and then count themselves as a dependent?
I love the way this person thinks. And I am guessing this would be the type of client that would, where their first tax return is their first offer to the IRS. I love it.
Sounds like it.
Unfortunately, this is not the case. It has to have a dependent, whether it's a parent that you're supporting or most commonly a child.
Still gotta love it though. Awesome. Well, any closing remarks for the two of you as we conclude this thing today?
It's been great, you guys. Thank you so much for sticking with us now for an hour and a half. So we really thank you. We know your time is valuable, and we thank you that you chose to spend it with us. Really appreciate the opportunity.
Yes, thank you. And you know, some of the questions need a little more information or detail to be able to answer adequately. I'm happy to be a resource. Feel free to reach out to me if I can help in any way.
Yep. Thanks, Connie. Thanks, Paul. And again, I guess, as much as we've been on your 90 minutes, thank you for all of you that are still on. What I do know is almost all the feedback, the Q&A is considered the most valuable part of these. So thank you, both of you, for being willing to stick with us and stay on the line for, after your prepared remarks are done in about 45 minutes, for another 45 minutes of just rapid fire Q&A. I know all of our attendees appreciate that. Honestly, possibly more than even the regular content in the first place. So thanks so much. We hope you all have a great day, and I look forward to seeing you all next week.